Okay, so this is going to be this month's webinar. I know we haven't had one in a little while. I'm actually in the process of rebranding a blog, podcast, all that good stuff. A new video channel on YouTube. So I've been working pretty hard this summer on that. So I promise we're going to get you a lot more content going forward. But this month we want to talk a little bit about the investment markets so far this year. Along with the big question, you hear a lot about what's going to happen in the bond market. That seems to be the big thing, all the chatter in Wall Street. So so far this year, it's been pretty ugly in the markets. The press has been favorable to the U.S. market. I know in politics, they keep talking, the Republican side keeps talking about a good year in the markets, blah, blah, blah. But really right now, as of the 12th of October, the S&P 500, which is the most common measurement for the U.S. market, is up about 3.5%. So it's up, that's good. But the bond market is down 2.2%. International stocks are down almost 10% this year. Real estate investment trusts, or REITs, they're down close to 7%. And in commodities are probably the only bright spot. They're up 7%. Of course, if you say commodities being up is a bright spot, that's probably not good for most people spending. Most of the commodity upside has been due to the price of oil going up. So that means you have to pay more when you go to the gas pump. But if you're investing in commodities, at least you've got a positive return so far this year. So really, when you look at those numbers there, it's been a bad year for diversification. I know a lot of you are probably going to wonder why the accounts seem so flat this year. Well, if you have typically anywhere from 35 to 50% in bonds, you've got half your portfolio in the negative. And then you throw in some international stocks, a little bit there, a little bit of the REITs. And then with only 3.5% on the upside in the U.S. market, it's just not a very good year for investments overall. And, the big thing that I mentioned already a little bit in the financial markets, everybody's talking about get out of bonds. Bonds are horrible. Bond rates are going to go up, which is bad for bonds. But is that really the truth? If bonds are going to get hit, what's really going to happen to stocks? And I'm trying to tell clients, I'm like, look, if bonds do take a beating, the beating that they receive is going to be minuscule compared to the beating that stocks receive. This is just a graph showing you real quickly. Last week, when the stock market and bond market both kind of got hit, you can see here the blue line is the TLT, the iShare 20-year Treasury. It was down about 3% last week. However, the S&P 500 was down 4.5%. So you had a bad week for Treasuries and the bond market, but it ended up being an even worse week for stocks. So we'll talk a little bit about that. But first, I think what I want to do is just talk a little bit about why bonds have a natural ceiling to what they're going to do. So bonds ultimately are tied to two things: GDP growth, or the growth of the economy, and inflation. So if those two things kind of stay in check, then you're really not going to have bond yields go way up, even if the Federal Reserve is raising rates. And that's the big argument. Hey, the Federal Reserve is raising rates, and we'll talk about that in a second. But at the end of the day, bond rates are going to be tied to the economy. If the economy is only growing at 2 or 3% per year, you shouldn't expect bonds to be much higher than that, quite honestly. And if rates do go up, let's say, for instance, we had things go up to 4.5%, 5% on the 10-year Treasury, well, that means that your borrowing costs, especially for mortgages and auto loans, are going to go up quite a bit. Those are going to slow the economy. So if the economy starts to slow, that means less economic activity. So essentially what you're going to end up having is bond yields would drop, as the demand for money drops. So even though we may be done with the bond bull market that started back in 1981, it doesn't mean that rates are just going to keep climbing, because you're so much tied to economic growth and also inflation too. That's the big thing. But what I mentioned is everyone's talking about how the Fed is raising rates and how that's going to just pummel bonds. Well, let's talk a little bit about the Fed. So this chart right here gives you an idea of the Federal Reserve's balance sheet. So the assets that they have on their books. You can notice here all the way up until really the end of 2008, before the 2008 crash, they had about $800 billion of assets. Most of them were treasuries. And this chart, if it went back 2 more decades, you would see that 800 billion figure stay consistent along with the level of treasuries. Well, what happened in 2008 is the Fed started buying assets from banks. We're talking mortgages, corporates, anything. They were buying all kinds of assets, not just treasuries. So if a bank was in trouble, what would happen is if the bank was in trouble, they would sell their asset to the Fed, and then the Fed would give them some nice cash. So now they get some clean cash, and the Fed takes their bad asset onto the bank or onto the Federal Reserve. So this chart just goes through 2010, where they're kind of capped at about 3.2 trillion. So from 800 billion to 3.2 trillion, the reality is right now they're about $4 trillion. They've continued to add to their balance sheet. So the Fed can actually tighten the liquidity. So as I just mentioned, that when the Fed increases their balance sheet, they take on the bad asset and they put cash into the economy. They can also increase the amount of liquidity or cash that goes in the economy through their interest rate, okay, the Federal Reserve rate. That's the rate that banks loan to each other. So as they drop that rate, it increases the amount of liquidity that goes into the market, okay, into the economy. So back in 2008, they dropped rates essentially down to 0%. And you can kind of see from this graph, that's exactly where it was like in 2014, 2015. They went down almost nothing. Well, they've started to raise it starting in 2016. And they've gone from essentially nothing now to about 2.2, 2.25%. So here again, what does that do? That reduces the amount of liquidity or cash that's out there because it's raising the borrowing cost for banks to borrow from one another, which means that they're going to pass that cost on to you as the consumer when you go to get an auto loan or a mortgage or something along those lines. So the bank is pulling liquidity out. Well, the fear is, though, as they raise this rate, this very short-term rate, this is the shortest term rate you can have. It's gone from 0 to 2.2%. Well, what the fear is that longer dated bonds, 5-year, 10-year, 30-year bonds are also going to go up because the short end of the yield curve is going up. That's the fear. That's what Wall Street keeps talking about. That's why they keep saying that things are going to get bad for the bond market. The other thing that the Fed is doing right now, along with raising the rates and the Federal Reserve rate, they're also starting to sell some of these assets that they were buying back in 2008, 2009. So when they ballooned up to over $4 trillion on their balance sheet, they're now starting to liquidate these positions. So here again, when they sell these positions, they're going to put the asset out for sale, and then they'll get the cash and pull the cash out of the economy. So it reduces liquidity. It tightens up the money situation. So you can see right here, since they've started this program, they've already sold about $260 billion of assets off their balance sheet. And the Fed says they're going to continue to do this all the way through 2019 at I think it's $50 billion a month. So another $600 billion could possibly go off of the Fed's balance sheet. So people who are against the bond market say that's going to hurt bonds as well. We're pulling liquidity out. Well, why would the Fed want to do this? And why would they be increasing the Federal Reserve rate? Well, the Fed has to have some ammunition in their holster for the next recession. What they've done in every recession dating back to 1969 is once the recession hits, they drop rates drastically. They infuse the economy with cash and liquidity. So they get that out into the economy. That helps that money start to circulate. People start buying things. The economy tends to improve. Well, the problem is when they went down to 0% Fed funds rate, they really had no ammo left. So even today, they're at 2.2%. So if we had a big time recession, the Fed, as far as their interest rates, could only go down to 2.2%. If you look at the past recessions, they've basically been an average of 7%. They've dropped them. So really not that much ammunition left in their holster. So that's one of the reasons that they're kind of raising rates to sort of normalize things so they have some tools when the next recession hits. So the next thing to kind of look at for the people who are thinking the bonds are doomed is what is the relationship between bonds, stocks, and inflation? So here again, I mentioned that bonds are basically a barometer of economic growth and inflation. So if either of those two start climbing, then bond rates are probably going to climb as well. What you can see here in kind of the cyan, I guess that's the color sort of off green, are bond returns as far as a percentage. The blue is stock returns, and then the yellow line is inflation. So when we have what they call deflation, so the far left, where you see that the yellow line is dropping, that is deflation. We had deflation back in the Great Depression. We had deflation in 2008. That's really good for bonds. So it kind of makes sense if the economy is shrinking or inflation is shrinking drastically. Bonds, the current bonds out there are probably going to do pretty well. You're going to make some money on bonds. Stocks also do pretty well, but they just don't do quite as well as bonds do in that kind of an environment. Now, in a low inflation environment, sort of the middle of the graph, stocks tend to do very well in that situation. Bonds do okay, but they're not, it's really nothing that great. But it's the far right of this graph where you start to see inflation really tick up past 4%. Here you can see bonds don't do well at all. And really, when we get to high inflation, stocks don't do well either. Now, stocks don't do as poorly as bonds in a high inflation environment, but they still don't do all that well. Now, the thing is, if you look at this graph, you're seeing inflation rates of, above 4. You start to have negative returns in bonds at 7% inflation rate. And then, of course, the last number there is 19% inflation rate. I just can't see the situation where we would have any kind of inflation near that in any way, at least right now. If prices started to climb that fast, you're going to have less spending. You're going to have a slower economy, which is naturally going to bring inflation back down. We just don't have enough economic growth. We haven't broken 3% in any given year since 2007. So we just don't have the momentum to get to that kind of inflation. So it's also why I kind of think bonds are still okay to be there. There's going to be some fluctuation in bonds, but as far as an imminent rise, a continued rise, I just don't see it. Again, I mentioned inflation is a big predictor of bond yields. And right now, the way the markets are pricing inflation is really, about 2.2, maybe 2.5%. That's really all you're looking at according to what the bond market sees today. So what this is creating is something called an inverting yield curve. We're not quite inverted yet, but what's happening is the Federal Reserve is raising rates. So they're on the very short term of the yield curve. So think of a yield curve. Obviously, your far left is going to be short maturity, short duration bonds, and the far right is going to be 30-year bonds. So what you have is the short end is going up because the Fed is raising rates, but the long end, as the last graph shows, is still only pricing in 2.2% inflation. So the long end, although it's gone up this year, which is why bonds are down 2.2%, it hasn't been that large. So we have a situation where the short end, the far left of the yield curve is coming up, and then the far right is kind of staying where it's at. And you can kind of see that from this graph here. So what does that mean? Well, an inverted yield curve, which means that the long end actually ends up being shorter than or equal to the short end of the bond curve. So the right side is equal to or less than the left side of the yield curve. Well, that usually precipitates a recession. This is a chart here showing you right before the 2007 or 2008 recession. You can see really about 6 months before the recession started to hit, we had an inverted yield curve. And if you think I'm just kind of pointing out one time, here's the past few recessions going back to the late 80s. And you can see pretty much every time the yield curve inverted, a recession wasn't too far away. Now we have not inverted yet. We're awfully close, but we have not inverted. So let's say the yield curve inverted now. Historically speaking, you're looking anywhere from 6 months to a year before recession, usually. Now, this is a pretty good predictor of a recession. What you have in that situation is the long-term investors in bonds are saying we don't see the economic growth such that we should raise on the long end of the bond yield, the bond curve. So basically, long-term investors are saying we don't see the economic growth that the short-term investors in bonds are seeing. That's how things end up inverting. So, when long-term investors are basically, calling BS to the Fed, that's what you get. You get an inverted yield curve. And it's been a very good predictor of recessions. And you can kind of see here, this chart gives you the 10-year. The first thing is a 10-year Treasury minus the 3-month Treasury yield spread. So you're looking at 3 months versus 10 years. And then the blue line is GDP growth. So where we're at today, essentially the bond market is saying we expect to see roughly about 2% GDP growth. They're not expecting a big uptick in economic activity at these levels. And I know we've had a good quarter last quarter. Everybody's heard about it from the TV, 4.2%. That was just one quarter. We've had, ever since 2009, we've had at least one quarter where it's gone above 4%. But yet on the annual basis, we're still just struggling to get past 2.5% in economic growth. So that's what basically the yield curve is telling us right now. This is just a chart showing you in general what happens as the yield curve inverts. For the first 6 months in 08 and 2000, you still saw an up market. So the market was up about 5%. However, once we got to the 1 year mark, you can start to see, at least in 08, it was still up about 10% from when it inverted. But in 2000, it was already negative return for the markets. But the 2 year, 3 year is where it really got ugly. So, my premise is, bonds haven't done much this year. They're down a little bit. They're ugly. They're not glamorous. The stock market's been the place to be. But if we have liquidity coming out of the market through the Fed hiking interest rates and selling off assets on their balance sheet, I think it's going to be a much rougher ride for stocks. And we'll explain why. The first one is just the general evaluations of the market. I mean, it is extremely expensive on any kind of historical measurement. All the valuation measures I look at shows that the stock market is extremely expensive right now. This is a graph of the Buffett indicator. So all the Buffett indicator this is Warren Buffett. He likes to understand the valuations of the market. If you take the value of the Wilshire 5000, which is basically a representation of the entire U.S. stock market. If you take the 5,000 stocks in that and you divide it by our gross national product, which is kind of like GDP, it's essentially a benchmark for the size of our economy. So you take all the listed stocks the 5,000 stocks that make up most of the stock market value, divide that by the size of the economy. That gives you an idea of how much of our economy is being priced into the stock market. And you have to remember, 5,000 listed stocks, 5,000 stocks on the stock exchange. Well, listed stocks is still a small percentage of all the businesses out there. Most of the businesses in America make less than $1 million a year. Small business is the largest driver of our gross domestic product and gross national product. So if you have most of your economic activity coming from small companies, so if the GNP is mostly small companies, then when this figure shows that the Wilshire 5,000 is getting to be more than the size of our economy, we're getting to be a little bit expensive. So where it stands right now is the value of the Wilshire 5,000 or the U.S. stock market is 1.4 times the size of our economy. That's not good. The average is about 74%, just to put it in perspective. So we are basically double the average right now, and we're at an all-time high, even when you factor in year 2000. The other thing that has me alarmed about the stock market is fewer companies are carrying the stock market. In fact, the past 12 months, over 25% of the market's gain has come from 5 stocks. They're affectionately called the FANG stocks: Facebook, Amazon, Apple, Netflix, Google. Those stocks alone, those handful of stocks, have accounted for more than a quarter of the stock market's gains. And kind of what this shows you is just this percentage of people who are bullish on the market as compared to bearish. Okay, so when investors are very bullish on the market, that's typically a bad sign. You can see when we've hit peaks before, a bear market isn't too far away. When the bearish sentiment is the highest, as you can see from 2009, you can see it in 81, that's when it's the best time to be an investor. And this chart just shows you the S&P 500 if you pulled out technology and then divided by the S&P 500. That's essentially what we're looking at here. So you can see that obviously in 2000, when the graph is going down, it's because technology was a big part of that. But really what's crazy is the last 8 or 9 years, if you pull technology out of the S&P 500, the market is flat. So this is telling you that most of the gains that we've had in the stock market, most of them have come from the tech sector. Again, a very small part of the market is leading the entire market, which isn't really healthy. This is just another way to look at it. Percent of stocks where their 50-day moving average is above the 200-day moving average. And this is dropping. That's not a good thing. We're just below 50% right now. So that's telling you a lot of companies are struggling. So again, fewer and fewer companies are holding up the stock market. What happens if these companies start to get hit a little bit? So I mentioned, I think it's going to be much more difficult environment for stocks than bonds as the Fed pulls out this liquidity. And this chart kind of gives you an idea of the S&P 500 overlap by the various quantitative easing operations that the Fed has undertaken since 2008. So they had QE1, QE2, QE3, then they had this other thing called Operation Twists. Well, you can see once they did these quantitative easing, meaning they put more liquidity into the economy, the stock markets did very well. So anytime we had that happen, stocks did well. Anytime the Fed stopped with these QE programs, what you saw was the stock market also got hit. And let's think about it logically. So you're pulling liquidity, you're pulling cash out of the economy. Now, right now, the Fed has pumped in so much money into the economy, really over $3 trillion. Everything's done well. Bonds have done well. Real estate's done well. Stocks have done well. Well, now that that's coming out, we're going to start to see exactly what's happening with the different asset classes. Well, what's typically happened in the past is every time one of these QEs have stopped, everybody said bonds were going to get hit. The Fed's not buying as many bonds. That's going to be bad for bonds. But what ended up happening was bonds did well and stocks got hit. Kind of makes sense if you think about it. So this money's coming out, liquidity's coming out. So people are going to run from the more volatile asset classes like real estate and stocks and go to where they see a safer return, which is usually bonds. So as the Fed continues to tighten, what I expect is going to happen is stocks are going to see the struggles a little bit more than bonds. And as stocks start to struggle, money's going to leave stocks and go to bonds. That's traditionally what's happened. I think it's probably going to be safe to say that that's going to happen again. Now, the one area of stocks that I think there's some opportunity is what they call value stocks. So I've shown you already that we've had fewer and fewer companies that have been leading the stock market, mostly technology stocks. Those are growth stocks. Facebook's a growth stock. Apple, growth stock. Google, a growth stock. So a lot of the money has been going to growth. Well, value has been ignored. Value is going to be a little bit, either companies that have been beaten up, so now there's some value there. They've lost some share price, so now kind of looks like it's a compelling investment. Or they're companies that are sort of old and stodgy, good dividend payers, good cash flow, but they're not real sexy. You know, you might be thinking like a Coca-Cola, a Clorox, Procter & Gamble, Colgate, stuff like that. Utilities are another one. So we've had a situation where growth has just been pounding value for quite some time. So now, you know, as everything in life is cyclical, especially in the markets, it might not be a bad time to look at adding some value to your portfolio. You notice for clients, I've been adding consumer staples. So we're talking, again, the ones I already mentioned, the Clorox, the Colgates, Procter & Gamble's, things along those lines. Utilities is another area that could be pretty good. So they're very good dividend payers, very boring though. They're very value driven. So looking for value, I would expect to see over the next few years, value start to outperform growth. Now, the other thing is when I kind of talk about, hey, we could possibly be facing a recession. We could be seeing the stock market slip up. We're not seeing the economic growth that we really think we're going to be seeing. Everybody points to unemployment. Hey, it's so low. You know, that's got to be great for the economy. You have to remember something. Unemployment is a lagging indicator. Okay, unemployment is something that it gets better as you get closer to a recession. And I know that doesn't make any sense. But that's exactly what happens. So if you think about it, it kind of makes sense. When we head into a recession, what do companies do? Once we're in a recession, they lay people off. So you see the unemployment rate go up after we've already started to struggle. Companies don't do it proactively. Say, hey, I think there's a recession coming. Let's lay people off. No, what they do is they wait until they're having financial issues. They're not getting cash flow. And then they lay people off. Okay, so by the time we hit unemployment, once we see that starting to climb, usually we're already through the recession. And then things get better. Companies start to see cash flow improve. So what do? They end up hiring people. Unemployment rate goes down. So usually, this chart shows you the unemployment rate bottoms right before a recession. So we're at, an 18-year low right now. So what is that telling me? Well, that tells me, hey, we might be close. It's not a perfect predictor by any stretch of the imagination, but you don't have a recession with a high unemployment rate. You have a recession with a low unemployment rate. So when people are talking about that, that's essentially what I'm thinking as far as unemployment. Another area that could be a good time to look to invest in, outside of value stocks is commodities. So past few years, commodities have just gotten beaten down. I mean, oil got down to $30 a barrel. Gold's been struggling. Copper's been struggling. But if you start to compare that to the NASDAQ 100, which is tech stocks, so growth stocks, we're really at kind of an all-time low, or at least we're matching where it was back in, like the 2000 bottom. So you might want to add a little bit to some commodities. That could be a place to find some value right now. So that's basically this month's webinar. I just kind of want to let you know everybody's calling for the end of bonds. I don't think we're there yet. In fact, if what the Fed is doing is going to affect bonds, well, it's probably going to affect stocks even more. But if you're looking for places for some safety, I think consumer staples, utilities, telecommunications, those could be sectors that are pretty good because they haven't really experienced much of an upside, and they are traditional value plays. You also might want to look at adding some commodities, which haven't done well the past few years, but probably getting close to a point where they're going to be a pretty good opportunity. So again, if you have any questions, please let me know and be happy to discuss it.